answer with Marketplace. So when we have our next recession, the Fed will have less room. It will happen. The Fed will have less room to maneuver cutting interest rates since you're cutting now. How big of a problem will that be?
You know, the premise is not. I'll question your premise for a second. If you remember, whether again, one of the purposes of our cut today is to support the expansion, and we don't know when. And if it really works, if that works very well, and the economy gets going again, you know. You don't know where the funds in other cycles, and I don't know whether this will happen or not. But in other cycles, the Fed wound up raising rates again after a mid-cycle adjustment. Again, I'm not predicting that, but I don't think that we know that we'll have less ammo because of these things. That's one thing.
You won't be able to cut as much if rates are low. I mean, you will have less ammo in that sense.
Well, but you're assuming that we would never raise rates again. That once we've cut these rates, they can never go back up again. As a matter of principle, I don't think that's right. In other long cycles, long U.S. business cycles have sometimes involved this kind of event where the Fed will stop hiking, in fact, will cut, and then we'll go back to hiking again. I don't know whether that'll happen here. It doesn't seem like something that's in particularly likely, frankly, but we don't know that. And the other thing is, I think by extending the cycle, you do have a lot of benefits from that. And I think we will use the tools that we have. A couple of rate hikes, one way or the other, isn't going to matter so much. If there is a downturn, you're right, there will eventually be one. We'll use all of our tools aggressively as we need to when that time comes.
Hi, Jean Young with M&I. Can you give us an update on the ongoing reassessment of the inflation framework, and have the discussions so far this year had any bearing on today's decision?
So the monetary policy review is really it's really there to look at the way we make policy in the longer run, and it's not something that enters directly into our discussions today. We've had a series of meetings called Fed Listens at almost all the reserve banks. Soon it will be all the reserve banks. And we meet there with the constituencies that we serve. And they've been very, very successful hearing from people, not just economists, but people who are not economists, how their lives interact with the Fed's work. It's been great. I got to say, it's been even better than I hoped it would be. We're just now beginning the process of incorporating all of that feedback. And we're going to be having a series of meetings beginning today and yesterday as we evaluate the questions that we're asking about our framework. So it's very early to say where that's going, but we're setting the table now and looking at what our framework is and looking at how it's performed, looking at how all frameworks performed around the world during the global financial crisis. I expect we'll be at this a while. I'm very excited about it. I think it's been a good exercise. I think it's opened us up to sunlight and perspectives that we might not have gotten otherwise. And I think it's a good time. You have 10 years after the crisis, you're really living in a new normal for the economy and monetary policy, and it's a really good time to step back and ask whether there are some things that we can do to improve our framework.
Courtney and then Brian for the last one.
Hi, Mr. Chairman. Courtney Brown from Axios. Can you give us a sense of whether the committee feels constrained at all by the market's expectations for more cuts or other developments in financial markets?
So I think this was well telegraphed. What we did today was very consistent with what we had said we were going to do. I mentioned the reasons for it. They've been well telegraphed, and I think I think they will achieve their goals. We do know that monetary policy works through communications and then actions that are consistent with those communications, and we think that the changes that we've made this year have really worked. Of course, we always retain the flexibility to adjust our communications and our actions in light of incoming data and the evolving risk picture. But I'll leave it there. Yeah.
Brian Chung with Yahoo Finance. Just to expand on that point about communication, I mean, we saw that markets have been particularly sensitive with regards to New York Fed President John Williams' remarks before the blackout period. So the Fed added language in the statement that says that the committee is contemplating the future path of target range for the federal funds rate as it monitors implications. I'm wondering now there's kind of this inflection point about whether or not the downside risk, because you've had to cut rates, outweighs the fact that you still see a positive outlook of the U.S. economy at a baseline. So just wondering if you can kind of clarify all of those things within the context of the challenges of communicating it.
Yeah, so again, I see the U.S. outlook as being a positive one. And we have had these global, really, risks to the outlook. There really is nothing in the U.S. economy that presents a prominent near-term threat to the U.S. economy. As I mentioned, there's no segment that's really, or sector that's really boiling over and overheating. Nothing like that. It's within the economy. It's healthy. So I would say that downside risks are really coming from abroad, and of course we are concerned about low inflation. And by the way, those risks from abroad are affecting the manufacturing sector here and business investment, fixed investment.